Hey everybody, glad you're here. This is awesome. Welcome to the Westside Investors Network. This is what it's all about. Honestly, if we could just stop right here. Mel, go home. We're doing this. We're networking. This is what it's all about. We do have a market update. I'm going to introduce you to Chris, my boss. He's a man who treats every property like it's the one. He's a veteran broker with an eye for detail. He's been in the industry for 20 years in Portland, the rental industry. Father of two. When he's not spending time with his family, his favorite pastime is, I didn't prep him for this. What's your favorite pastime, Chris?
Ooh, it's gotta be golf.
Yeah.
Forest bathing on the golf course.
There we go. And I recently found out that you have played poker at a very competitive level, which is kind of fun. So, and when he's not managing portfolios, he's building long-term wealth for his clients through syndications. Let's hear it from Mr.
We're gonna pull through. Oh, here I am. Nice to meet you all. Okay, so we're just gonna look at March right now. So this is the last month of data that we've got. And so this is March from the last cycle, 2005, which is a huge construction year, massive top of the credit cycle. It was actually kind of fueled by some illegal loans, and that's different than this cycle. And so Pronghorn down in Bend, that was something that was developed then with that lending environment, and it still hasn't stabilized. Two great golf courses though. Fazio and a Nicholas. And then 2006, volume came down a little bit. Value's still going up. 2007, volume came down a little bit. Value's still going up. And then finally, 2008, activity really got crushed. And values didn't get hit that much. 2009, values pricing started to get hit pretty significantly, and as well sales activity. And then sales activity was kind of down by 40 to 50%, just with that huge boom and blow off the top cycle. And so if we look at this cycle, it's not as dramatic, but it is similar. So if you look at 2019, solid year, I would say that 2019 was just kind of like a really just like base strong year. That's a normal strong year. And then the other part about this cycle too is that there are about 200,000 more homes in the Portland metro, just from natural building. So there should be more sales activity because there's just more homes. And so 2020, normal sales activity. I mean, shoot, we had a pandemic, but there was also helicopter money. So that, is very interesting. And then 2021, we had the best interest rate environment that I've seen in my lifetime. And part of 2022, we also had that incredible interest rate environment. And so if you're looking at the sales activity in the run-up, we are seeing that 2022, even though rates massively changed character second half of the year, anything that got into contract, in May or June, that may have closed in September or October, they still had great rates. And so most of the year, we were getting very good rates. And then 2023 hit, and interest rates were really bad. Sales activity dropped about 40%. I guess the other thing that I wanted to show, and so we're 4 years into about 40%, or sorry, 60% of sales activity. And so, you know, that's relative, I'm gonna go back to the last slide. That's relatively similar to, we had 5 years of muted sales activity for the Great Recession. And so I like to just draw that correlation. The other thing too is that if you look at values, and I'm just pulling the median price, so the median price for this cycle has stayed relatively flat. It hasn't taken a dramatic drop. During the last cycle, the drop was, I don't know, 30 or 40% peak to trough. This, we're only, you know, maybe down like 5%. But the key factor here is inflation. And with expenses being up 25 to 30%, like utilities, labor, supply, like building materials, that is actually a hidden recession, because the replacement cost of building one of these properties is significantly higher. And so, you know, and also just how much a dollar buys is significantly lower. And so it's not really showing up this cycle, but we're actually, you know, inflation adjusted down like roughly 15% on top of the 5. So this is just March. We are ticking up in 2026, you know, about 10%. And, you know, values are back to peak, you know, median price is back to peak, just based on the RMLS data. Okay, and then I've got, so this is even more, oh wow, what do we got here? Okay, this is annual data, so just quickly, 2004, boom year, 2005, boom year, and then 8, 9, 10, 11, were all about half or 40% off or 40% below activity. But I guess what I want to draw on is during this cycle, as sales activity dropped for the first couple years, prices went up, and then as you know we got into like the recovery of sales activity, prices were actually still dropping. And so like that's where we are right now. We are at the point in time where sales activity is starting to come back up. We've got some volume happening. I mean, not a ton, but this is the recovery of volume. And prices aren't necessarily going to recover immediately. It's possible that they could go down lower now that like there's actually buyers coming into the market. A buyer right now is going to demand a pretty good deal because they have the upper hand in the transaction. It's really a buyer's market. And so for anyone who's an investor, like this is a pretty phenomenal opportunity from my perspective. So here is this is the amazing run that we had from 2014 to 2019. Essentially, total sales volume went from 11 billion to 16 billion, like across the metro. Like that's massive. Median price went from 285 to 410. That is an incredible, like over the course of 5-6 years, that is, and like when you invest in a property, you're investing 20% down, or if you invested FHA 5%, we've got an incredible seller financing deal. Like you're not talking 30% gain. You're talking, okay, I put 20% down, you know, on this $285,000 property. That's 60 grand. Now it's worth 410. So I just made 350% on that investment that I made. And so that's what a really good run looks like. Okay, and then this is where we're at right now. These are the annual numbers. I just want to highlight the sales activity. 2021 was our peak year at 40,500. This peak year is actually lower than the peak year of 2004, which I find very interesting because there was more housing stock available in 2021, roughly 200,000 more units. And so honestly, the even though interest rates were so low, it was still pretty difficult to get a loan. In 2004, 2005, anybody could get a loan. Literally the no doc loan situation. So like these, what is it, Dodd-Frank? Whatever the lending rules that got put into place after 2008 have made the getting a loan actually very difficult. And I experienced this my whole life. Well, my whole 20 years I've been in business. But yeah, basically I wanted to do a quick run of, these are some of the purchases that my brother and I made over this period. So we started in 2006, 2007, and buying cheap single family homes for $200K. And then a year later, we were buying cheap single family homes for about $100K. And that was how we got into the real estate market, is literally the properties that we bought were literally worth half what we paid for them, in 1 year. And I mean, I didn't realize it at the time, but it was a good lesson to learn. And then, steadily, prices just went up. We bought homes for 125K, 150K, 200K, 300K, and, 600,000. And all of those properties, some of them have been great, some of them have been tough, but we've been able to operate them. And I guess the point to make here is that trying to time the market is, I don't think it's worth it. I don't think trying to time the market is, and even though now is an amazing time. So my point here is that now is the time. And so we bought some multifamily properties to 115K in 2011, and now we're buying units for 115K, or no, 138K. We've got a couple deals that we have in contract right now. But if you look unit per door, 136, 128. We got something for 100K last year. Those are mostly one bedrooms. And it's really if the P&L makes sense. So, yeah. So what do I think is going to happen next? I think there's 3 possibilities. So what I really think is that there's just going to be a slow grind. We've got that slow grind out of the trough. Sales activity is going to come back. Interest rates are going to be sticky, somewhere between 5.5% and 6.5%. That's not what the mortgage brokers want to hear. But basically it's going to be a slow grind. And so, owner financing and sub-2 and creative strategies are going to be huge during this time period. That's actually what my dad did in the 70s, is he would buy deals, owner financing, and then he would sell them rent to own. And so that's scenario 1. I think that's most likely. Scenario 2 is somehow interest rates go down. Just looking at the interest rate market and studying markets, to me, it just doesn't seem that likely. I owning a decent sized portfolio. I would love to refinance some stuff because we've got some high loans, but I just don't think it's going to happen. But if that does happen, then there's the sales activity is going to go nuts, and then prices will go up. The buying opportunity that we have right now will kind of dissipate for a little while. You'll have to get a little more creative, and you'll have to operate a little stronger. And then scenario 3 is that something breaks. Something in our economic system breaks, and basically times get tougher. NOI is already net operating income for multifamily properties and other investment properties is really stressed right now with higher expenses, higher interest rates, capped rents. Not capped rents, but rents are lower, so it's already difficult. owning and operating investment properties. But scenario 3 could be where something gets, it could get even worse. But I just don't really see that happening either, but it's a possibility. That would really create an incredible buying opportunity where, people aren't able to pay their loans, the bank is getting properties back, and that is what happened in 2008. And that was something that my AJ and I, my brother and I, were very lucky to start our real estate careers right at that time. We had bought a couple and got hit pretty bad, but then as we were really getting into it, we entered into that scenario 3. How to get started in this market. The gist of this slide is start now. If you have capital, find a good deal and do it. If you don't have capital, find a good deal and then find somebody to do it with you. So, if there's anything that I've learned in the past 20 years of doing real estate, it is taking action, taking a little bit of risk, and just believing that we live in a pretty incredible place, and people are going to want to keep coming here. So there we go. Any questions?